currency worldwide. Its story began not long after America itself was born. The Coinage Act of 1792 was a foundational piece of legislation. This act officially established the dollar as the nation's currency. It also defined its value in terms of gold and silver. This system, known as bimetallism, aimed to provide stability. A young country needed a reliable currency for its economy to function and to gain international trust. However, making this system work smoothly presented numerous early difficulties. Over the course of the 19th century, the United States gradually moved towards a gold standard. Gold discoveries, like the California Gold Rush, increased its availability. This made relying solely on gold more practical than the bimetallic system. The Civil War briefly interrupted this with the issuance of greenbacks, a type of fiat currency not backed by gold. But after the war, there was a strong push to return to metal-backed money. Gold was seen as the ultimate symbol of sound money. It was believed to prevent governments from printing too much money and causing inflation. The Gold Standard Act of 1900 formally cemented the dollar's link to gold. This law explicitly stated that the dollar was redeemable for a fixed amount of gold. This move was significant. It provided a clear anchor for the dollar's value. Many other major industrial nations were also on the gold standard at this time. This international system was thought to simplify trade and investment. Exchange rates between currencies were relatively stable because they were all tied to gold. This created a predictable environment for international commerce. However, the gold standard faced severe tests. World War I placed immense financial strain on participating countries. Many suspended gold convertibility to finance war efforts. Later, the Great Depression of the 1930s created even greater pressure. Nations abandoned the gold standard to devalue their currencies and boost exports. The United States itself devalued the dollar against gold in 1934. While it officially remained on a modified gold standard for international transactions, the rigid link was weakened. These events highlighted the inflexibility of the gold standard during economic crises. After the devastation of World War II, global leaders sought to create a more stable international economic system. They wanted to avoid the chaotic currency devaluations and trade protectionism that had plagued the 1930s. In 1944, representatives from 44 allied nations gathered in Bretton Woods, New Hampshire. The United States, with its economy largely intact and booming, played a dominant role in these discussions. The primary goal was to design a framework that would foster international monetary cooperation and support post-war reconstruction and economic growth. The Bretton Woods Agreement established a new international monetary order. The United States dollar was placed at the very center of this system. It became the world's primary reserve currency. This meant other countries would hold US dollars as their main foreign exchange reserve. The dollar itself was pegged to gold at a fixed rate of $35 per ounce. Other participating countries then pegged their currencies to the United States dollar. This created a system of fixed, but adjustable exchange rates. The International Monetary Fund and the World Bank were also created to oversee this system. The dollar's role as the global reserve currency had profound implications. Central banks around the world accumulated significant dollar holdings. International trade and financial transactions were increasingly conducted in dollars. This greatly enhanced the United States' economic and political influence on the global stage. It also meant the United States bore the responsibility of maintaining the dollar's gold convertibility at $35 per ounce. This was a commitment that required careful management of its own economic policies and gold reserves to ensure global confidence. For about 2 decades, the Bretton Woods system largely succeeded. It provided a stable environment that facilitated a remarkable period of global economic expansion. Countries in Europe and Asia, notably Japan, rebuilt their economies. International trade flourished. However, strains began to appear in the late 1960s. Increased United States government spending, partly due to the Vietnam War and domestic social programs, led to inflation. This, combined with a growing United States trade deficit, meant foreign central banks accumulated even more dollars. Doubts about the United States' ability to honor its gold commitment began to grow steadily. By the late 1960s and early 1970s, the pressure on United States gold reserves became immense. Foreign central banks held far more United States dollars than the United States Treasury had gold to back them at the promised $35 per ounce rate. This imbalance led to increased speculation against the dollar. Countries began to redeem their dollars for gold, further depleting United States reserves. The United States faced a critical choice: drastically devalue the dollar against gold, implement painful austerity measures to reduce imports and inflation, or abandon gold convertibility altogether. This was a significant economic policy challenge. On August 15, 1971, President Richard Nixon made a historic announcement. He unilaterally suspended the direct convertibility of the United States dollar into gold. This decision, often termed the Nixon shock, effectively ended the Bretton Woods system of fixed exchange rates. The dollar was no longer tied to gold; it became a fiat currency. Its value would now be determined by market forces, government policy, and trust in the United States economy, rather than a physical commodity. This was a radical departure from centuries of monetary tradition for many nations. The immediate aftermath of the Nixon shock was a period of uncertainty and turbulence in global currency markets. Exchange rates, which had been fixed for decades, began to float. This meant their values were determined by supply and demand in foreign exchange markets. There were attempts to re-establish a modified system of fixed rates, known as the Smithsonian Agreement, but these efforts were short-lived. The world was moving into uncharted territory. Many economists and policymakers worried about the potential for instability in a system without a gold anchor. Despite the initial disruption, the global financial system gradually adapted to the new reality of fiat currencies. The United States dollar, surprisingly to some, maintained its dominant position. This was largely due to the sheer size and strength of the United States economy. Its deep and liquid financial markets also played a crucial role. Inertia was another factor. The global trading infrastructure was already built around the dollar. Trust, which once resided in gold, shifted towards the perceived stability and creditworthiness of the United States government and its institutions. Today, the United States dollar remains the world's foremost reserve currency. A large majority of international trade transactions are invoiced and settled in dollars. Key commodities, most notably oil, are priced in dollars, a system often referred to as the petrodollar system. Central banks across the globe continue to hold substantial portions of their foreign exchange reserves in United States dollar-denominated assets. This widespread use grants the United States what some have called an exorbitant privilege. This includes the ability to finance its deficits more easily and exert significant influence over global finance. Several factors influence the value of the United States dollar in the modern floating exchange rate system. United States monetary policy, set by the Federal Reserve, is a primary driver. Changes in interest rates and quantitative easing programs directly affect the dollar's attractiveness. The overall health of the United States economy, including growth rates, inflation, and employment figures, also plays a significant role. Furthermore, global risk sentiment is important. During times of international uncertainty, the dollar is often seen as a safe haven currency, causing its value to rise as investors seek security. However, the dollar's long-standing dominance faces several potential challenges. The rise of other major economic powers, such as China with its renminbi and the Eurozone with the euro, presents alternatives. Some nations have expressed a desire to reduce their reliance on the dollar, a process known as de-dollarization, often driven by geopolitical considerations, and a wish for greater monetary autonomy. The rapid development and potential issuance of central bank digital currencies by various countries could also reshape the landscape of international payments and settlements. Looking ahead, the future of the United States dollar is subject to various scenarios. It is highly probable that the dollar will remain a key, if not the primary, global currency for the foreseeable future due to its entrenched position and the lack of a clear, comprehensive alternative. However, a gradual shift towards a more multipolar currency system, where several major currencies share global influence, seems plausible. The ultimate trajectory of the dollar will depend on the continued strength and stability of the United States economy, astute policy decisions, and how effectively the United States navigates evolving global economic and technological landscapes.